This conference will now be recorded.
So guys, in the last session, I covered majorly on planning, right? The financial planning. Right, so we covered on finance, so financial accounting. So I clearly mentioned it, the finance has got three major statements, like the income statement, or we also call it as P&L statement. Second one is balance sheet, and the third is uh, your cash flow statements. So generally, these three should be made public by any organization, guys, any public listed company, okay, should release their um, P&L statements, everything. So you want me to showcase how the P&L statement look? Mm, Give me an example. Just give me a minute. Mm, I think you know this thing, right? Screener. Okay. This website has all the. I take some company. Let's take an automobile, Mahindra and Mahindra. M&M. So here, guys, I remember I told, right, book value. If your organization go bankrupt right now, so for one stock of 2,500 rupees, you'll receive only 532 rupees. If it goes bankrupt, okay, it doesn't mean the company will go bankrupt. Okay, so here you go, P&L, profit and loss statement. So generally, profit and loss statement is generated quarterly. Here you see, it is written yearly here. Just a moment, let me try other. So guys, here you see, I don't see proper quarterly figures here. Maybe I have it. There is another website where I go with Mahindra and Mahindra. Hmm. Normally, here you see. So every quarter it releases their earnings, right? So you see income statement or P&L statement, then you have balance sheet and cash flow. So these three things will be released to the public. So this is not detailed. This is not at all detailed, guys. So this is your total revenue. So your the top line of your P&L statement or income statement is total sales or total revenue, guys. Here you see this is your total sales or total revenue. If you open your total sales, how it is growing year on year. Hmm? The total sales. It's a quarterly view only. Quarterly results. Yes. Here you see on the quarterly results, you see the total sales happened in this quarter. Then you see the expenses, guys. Okay. Expense are broadly categorized into two categories. One is uh, material cost or your production expense, and second one is your operating expenses like your marketing expenses, sales expenses. I don't see the details here. I'm just seeing only the overall numbers. This is your sales happen, then your expenses. Sales minus expenses gives you operating profit, or we also call it as EBITDA. In normal terms, you heard this word anytime, EBITDA? Guys, heard this word? EBITDA, EBITDA, earnings before interest, depreciation, T for tax, and A for something like amortization or something. Okay, so that is like your profit, operating profit or EBITDA, we call it as. Then we have other incomes, which are like non-core incomes, guys. Non-core income in the sense, so for suppose this Mahindra and Mahindra is a cash rich company. Okay, they have a lot of cash in their books and they invested the cash in other in some other segments from which they are generating an extra revenue. That is like non-core incomes, we call it as. It's not, it's income from non-core business. Okay, so that is seen under other incomes. Then your company will have, if company has debts, they pay the interest on the debt, right? That is the interest component. And if your company has big assets, there'll be some depreciation, right? There'll be always a depreciation on the assets, right? Then after operating profit, so sales minus expenses gives you the operating profit for that quarter. Then you have other incomes, interests, depreciations. Okay, so these things plus or minus gives you the profit before tax. Okay, yes, your operating profit is 6,600. Then other income is 750. Then we have 2,000 crores on interest and 1,300 crores on, okay, what do we say, depreciation, 3,300 crores almost. So this 7,300 minus 3,000, you see 4,000 crores as a profit before tax. Then the company will pay tax, 22% tax on this, and overall the final profit is 3,125 crores. This is, I think this is in crores. It's in company. This is in crores. This all figure is in crores. So quarterly profit for Mahindra and Mahindra in the current quarter is 3,125 crores. Okay, so clear, guys. So generally, so you have when we see the performance of a company, okay, we always look at three factors. Okay, the top line, middle line. The top line is sales, how your sales are growing, how your revenues are growing, how your middle line, the operating profit is growing, how your bottom line, net profit is growing. Net profit is this, or the bottom line is this. So we always look at three things: the top line, EBITDA, and the bottom line, final net profit. But always, we always look at the performance of an organization based on EBITDA only, guys. We always look at the performance of an organization based on EBITDA, not on net profit, because net profit is dependent on a lot of external factors like your taxes, your depreciations, your interests, right? The company is a high debt company, they pay a lot of interest, right? So we always look at EBITDA as a parameter to check the performance of an organization. If your EBITDA is growing, okay, earnings before tax and depreciation and uh, interest, if that is growing, that means your company is doing good in its core segment, core business. Here you can see for this organization, the EBITDA is constantly growing 5,200, 5,600, 6,200, then slight dip again 6,200, again 6,600. Okay, so that is how you see this. So operating profit is a parameter we need always check. So this is how your income statement looks for any organization. The income statement pattern is same. Okay, so guys, in financial, why I'm more focused on this income statement is in financial planning we do P&L planning only, income planning only, income statement planning only. So where we do sales planning and expense planning. So we, and that too the planning happens only till operating profit, guys. There are a lot of accounts under, this is overall numbers, but if I open this, there are a lot of accounts under sales, lot of accounts under expenses. Okay, so this is like, so we do the planning only till operating profit. We cannot do planning on interest, right? Interest is like debt you take in and interest you pay. We don't do planning on interest, and we don't do planning on other incomes, guys. Other incomes are like some things which where your company has got some cash and they're investing in stock markets, they're investing in bonds to get extra revenues. So those things we cannot plan, right? And we cannot plan the depreciations. So that's the reason. So the entire financial planning happens at this level, guys. The financial in SAC or anywhere in any organization, financial planning means income statement planning. First point to be noted, in any organization, financial planning means income statement planning, and that too we plan only till operating profit. Okay, we always plan till operating profit only. We cannot plan on interest, depreciations, taxes, etc. The tax is calculated on your net profits. Okay, so we cannot plan. Okay, so then if you come down, this is yearly statements. Then you have balance sheets, guys. If I go on to the balance sheet, this is income statement. If you scroll down, you see the balance sheets. Same Mahindra and Mahindra only. The company's M&M. Okay, these are your current assets of your company. The current assets are like property and plant equipments, goodwill and intangibles, long-term investments made by the company. Okay, other assets, they all fall, and these are like current assets. These are the current assets of the company. Okay, so these are non-current assets. So total assets is this much, 2 lakh crores. And liabilities, guys, if you see the liabilities of an organization, long-term debt is 57,000 crores, and other liabilities 8,000. And non-current liabilities means which not to be paid right now is 66. The total liabilities of my organization is 137. So I told you, right, assets minus liabilities gives you the equity. This is like the floating equity. If companies go bankrupt, the stakeholders will receive this much amount, 60,000 crores. So equity plus liability should be equal to assets. Your asset value should be equal to liability plus equity. So liability plus equity is this much. Your asset value is also same. And total shares that were outstanding is, so right now your company has 119.81 crores shares floating in the market right now, outstanding shares 119.81. Okay, so if you divide by 119.81, you'll get the book value of a company. Okay, 67,000 divided by 120, it's around 500 something. Okay, 520 or something, that will be the book value if you go to the top. You see the book value here. Maybe here you see book value is 532. Okay, that is nothing but your equity divided by the number of shares, the number of outstanding stakes. So that is how you see the balance sheet. Balance sheet along with your income and expenses, you see assets and liabilities in the balance sheet. And generally, guys, we don't have much planning to do in balance sheet level, guys. We don't really do any planning in balance sheet, because what we do in planning in assets and liabilities. So guys, what we plan in debts, what we plan in bonds, or what we plan in machinery, etc. The only planning we do at balance sheet level is capex planning. Capex in the sense, if we are building anything new, okay, we are building some new plants, or we coming with some new IT projects. Okay, anything we're building new falls into capex. I'll discuss what is opex and what is capex. So only planning we do in at balance sheet level is capex planning. Okay, so as I can say, in finance, the planning happens at P&L statement, at operating profit level. Okay, where we do sales planning, production expense planning, operating expense planning, and generate a plan at operating profit level. So maximum cases, financial planning means income statement planning only. The only area where we generate a plan apart from income statement is capex plan. Financial planning means income statement planning plus capex planning. That's it. So 90% is income statement planning. There is some one component which doesn't fall into income statement is capex, capital expenditure. Okay, that planning we do at balance sheet level. Okay, so this is how a balance sheet of an organization looks. So here also you see balance sheet, equity, capital, reserves, borrowings, total liabilities. These are the total liabilities and assets of an, these are the total assets of an organization. Okay, this is equity, this is reserves. Cash reserves plus equity gives you equity. These two are equity. Borrowings and other liabilities gives you the liabilities, total liabilities. Okay, so equity plus liabilities is 236,301, and these are assets. Okay, fixed assets, current work in progress. This is nothing but capex. This is the capex happening from the organization. Investments made by the company, and other assets gives you this. Then you have cash flow, guys. Cash flows. Generally, we don't do any planning on cash flow. Cash flow contains three components: cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. We always look towards cash flow from operating activity. We always look at cash flow from operating activity. Okay, so cash flow gives you what are the total receivables which are not yet received. Okay, total received, and the inventory available. Total payable means how much we need to pay to the vendors or paid to the vendors so far. Okay, and other work items gives you the working capital changes. So your total cash flow, if it is in negative, that means it's a positive cash flow. If you see minus value, it's a positive cash flow. If you see, okay, then you see, so if this is in negative, cash flow from operating activities in negative, it's a good sign. So a company is generating a positive cash, means so anything going out of company is written in positive, anything coming into the organization is in negative. So we have this much cash generated at the end of year, financial year. Means in the last financial year, company has generated a net positive cash of 19,175 crores, which is a very good sign. Okay, then we have taxes paid by the company. Okay, then cash from investing activity. So this much fixed assets purchased by the companies, this much they purchase, this much. See, you know, if companies are cash rich, they do investment activities. If the company don't have big cash in their books, small scale companies, you don't see cash flow from investment activities. Large scale companies, guys, which have heavy cash in their books, and what they do, guys, I'll tell you very simple example. I take an example of Maruti Suzuki or Infosys. So these companies cannot grow at operations, right? They are already very big. They cannot clock a growth rate of 10% or 20% every year. Okay, they are already very, very big and they cannot really grow at a faster rate. So what they do is, how do they grow? Okay, their core business means their core business might grow 3% or 4% every year, but what they do is they already generated lot of profits, they already have lot of cash in their books. So what they do is they use that cash, invest in some other areas. Okay, like a lot of people invest in the equity markets or bonds market. Okay, and they generate an income from that cash whatever they have. So that what happens is, maybe their operating profit will grow 2% or 3%, but their net profit will grow very big because of the other incomes they generate from the investments. Okay, so one big example is, I'll give. Okay, so this is like fixed assets purchased by the company, fixed assets sold, investments purchased, investments sold, interest received. Okay, the dividends received. It's like that, you see. uh, and here you see the net cash flow is around minus 5,000 from investment activities. Then you have cash flow from financing activities. So if they proceeds, if they borrow something, or if they repay the borrowings, means they already had some borrowing, they repaid it. Okay, invest paid, dividends paid. For suppose the company paid dividends to the stakeholders, that is also you see in uh, cash flow from financing activities. So like that you see here. So operations, so we see three things: cash flow from operating activity, okay, cash flow from investment activity, and cash flow from financing activity. We always look towards cash flow generated from operating activity only. The cash flow generated from operating activity, from operations. We always look towards the cash flow from operations only. Okay, because that is the real cash flow generated by the company from investments and from financing. That, okay, here you see net change in cash, changes in working capital, capex the organization took, and the free cash flow is 13,000 crores, which is a good sign. Like that you see, guys. Okay, so generally we have cash flow statements, income statement, balance sheet, and cash flow. Guys, income statement gives you how much sales happened in every quarter they release the quarterly earnings. Guys, what they release every quarter is the income statement only. Guys, here you see every quarter they release the income statement only. Companies release income statement each and every quarter, so where they give you how much sales happened. Okay, sales in the sense the gross sales minus discount gives you the net sales, that is your top line. Then how much we spent in expenses. Expenses are broadly categorized into a lot of expenses are into different categories. Expenses are broadly categorized into two categories. One, production cost. First category is production cost, which involves your raw material cost, labor cost, purchase price variance, freight cost, etc., or logistics cost. That is production cost. That is one type of expense. Under production cost, you have this raw material cost, one type. Under production cost, we have sub expense categories like raw material cost, labor cost, purchase price variance, freight cost, etc. Then the second type of expense is operating expenses. Second type of expense is operating expense or OPEX. Okay. So this operating expense contains your marketing expense, how much we spend on marketing, sales expense, how much we spend on sales, maintaining sales stores, etc. Then we have IT expenses, how much we spending on IT day, running the IT operations of an organization. Then it has employee expenses like HR expenses, like employee salaries, bonus, wages, training cost, computer cost, etc., etc., burden. So these all falls into employee expenses. Okay. So operating expense has marketing expense, sales expense, operating expense, IT expense, and then we generally categorize in other category called other expenses like electricity costs, your internal logistics cost. Okay, so they all fall into other expenses. Okay, So these expenses are broadly categorized into two: production cost and operating expenses. Okay, production cost is how much we need to produce the product, and operating expenses is to maintain the day-to-day operations of a company, like marketing of the company, IT of the company, employee costs. Remaining all expenses falls into day-to-day operation expenses, that is operating expenses. Okay, so the sales minus production cost minus operating expenses gives you the operating profit. Okay, so sales minus net revenue minus expenses gives you the gross profit. Means expenses in the sense production cost gives you gross profit, production cost minus operating expenses gives you operating profit, or we also call it as EBITDA. So generally the planning happens at this layer. We do the sales planning, we do the production cost planning, and we do the operating expense planning. Okay, and generate the plan number, how much operating profit we're going to achieve in the next financial year. For that March 2025, how much operating profit we target, how much sales we are targeting, how much we're going to spend on expenses, how much we're going to spend on raw materials, how much we're going to spend on marketing, etc., etc. Everything is maintained or planned. So based on that numbers, the company's budgets will be allocated. Okay, based on the number forecasted numbers, the budgets will be allocated to different departments. To raw material department, this much budget will be allocated, like that. The budgets will be started allocating to different regions and different departments. Based on the budget, they will start consuming the budgets. Based on the budget numbers, they start running the operations. So maximum financial planning happens at this layer only, guys, at the income statement level. Clear? Makes sense? Any questions here, anyone? The only planning that doesn't fall into income statement is capex, which fall into your balance sheet. In the balance sheet, you see the current work in progress is nothing but your capex. Okay, only planning we do apart from income statement is capex. Even you see cash from financing activity. Sorry, sir, not finance. I think investment activity. Where do I see the capex, guys? Operating activity only. Other work items is capex only, I think. Other work items in operating activities, I think capex. Capex in the sense they're building anything new. It can be new software, it can be anything, guys. Okay, anything they're building new that falls into capex. It can be a new plant, it can be a new warehouse, it can be a new store. Anything new built will fall into capex, capital expenditure. Okay, so that is not seen in income statement. So only plan we do apart from income statement planning is capex planning. Clear, guys? Any questions here, anyone? Anyone, any questions here on income statement, cash flow statement, and balance sheets?
For planning, we'll use the financial planning only, right? Cash flow and all, it won't be that much be
There is
used for.
nothing to do in cash flow planning, right? Cash flow
Mhm.
planning is like how much we need to receive, how much we need to pay to how much we paid so far, how much we received so far. Okay, I told you, right? There is a one difference between cash flow and income statement. See, suppose you sold a product to a customer. That customer, imagine your customer is also another company, and they pay you after 30 days or 40 days once they receive it. But in income statement, once you sold, the sale is completed, you will show that in the income statement. Okay, we made a sale of 1000 crores, but out of 1000 crores sale, you received only 800 crores so far. So in cash flow, it shows only 800 net received.
Okay.
Okay, net received or net we paid. Again, we purchase raw material from some vendor, and we also pay the vendor after 30 days or 40 days. Your income statement will show 800 crores we paid to the vendors, but actually you paid only 700 crores. 100 crore you had to pay. So your cash flow reflects only that 700. So what actually we received, what actually we spent will be shown in cash flow from operating activities. Okay. Whereas in income statement, if sale is done, it was reflected in the books of income statement.
So the whole amount it will be reflected, right?
It
There?
reflects, the income statement reflects everything.
But
And there
actual
is
amount
nothing,
is the cash flow. What you
yeah,
mean?
the actual received is cash flow, seen
Okay.
in cash flow. Here you see the total receives is in cash flow. This much inventory we have. Okay. In the books means this is the inventory right now I have in the company. Okay. If we sell off the entire inventory, we might make this much amount. The payables, this is what we paid so far.
Okay. Accurate information can be referred to the cash flow.
Hmm.
Okay. Yeah. Thanks.
See, especially some kind of government organizations, like for suppose your company is some kind of a construction company. Okay, they don't post uniform results across all the quarters. Okay, if they complete the project, they will receive huge amount of money in that quarter. In another quarter, there is no project completion. Imagine there is no project completion. So obviously numbers will be low. So they don't post uniform numbers. The cash flow also in 1 year you might have received a lot of cash. In another year your all projects are ongoing and you didn't receive any cash. Okay, don't think from IT company standpoint. IT companies have universal numbers. IT FMCG they post uniform cash flows, but if you take construction related companies or companies which make some real estate companies, or if it's a real estate company, guys, they launch a new project, they'll get lot of bookings, a lot of cash they will receive in 1 quarter. In another quarter there is no launch. Okay, they don't receive any cash. So like that we need to see that cash flows always. It is from investor point of view, guys. There is nothing to do in planning, especially in cash flow. Cash flow, there is nothing to do planning. Okay, the planning happens only on income statement. Any company do planning only on income statements. Means we will be predicting. Planning means we'll be forecasting our future numbers, right? We cannot forecast our future cash flows because the cash flow is dependent on external factors. Okay. All right, guys. Any questions on this? The income statement and the cash flow and balance sheet and our major here. So P&L statement deals with all income and expense accounts. Okay. And the major planning always happens at the profit and loss statement. Any company, when it does the planning, it always do the planning at income statement level. And this income statement, this P&L statement will be released, will be made public each and every quarter. Each and every quarter, the company has to release their quarterly earnings. Quarterly earnings is nothing but finance, profit and loss statement. Anyone, any questions here? At least you understood, right? You're understanding the things.
Yes, yes, Satya. Yeah.
So
Such.
I'm not really directly jumping into the planning. I'm giving you all kind of prerequisites so that you understand the planning. Okay.
Yeah, this is good actually.
Yeah, it's good. Hi Satya, I missed one point. How come the negative cash flows will be good sign that you said? How come? I mean, how come it is? I missed that point.
See, Samba, even I'm not sure how they write this websites write in different way. Okay.
Mhm.
Uh, we need to look at the actual company cash flow. One website represent in one way, another website represent in another way, the cash flows. Okay. But negative cash flows, see, generally if we are receiving, right, we will give the number in negative. If we are paying, we give it as positive. Always a
Right.
negative number is good sign. If we are in the receiving end, if company is in the receiving end, it's negative. If company is in the paying end, it is positive. Some websites write like that, some websites write reverse. Okay. As far as I know, screener writes receivables in negative and payables in positive.
Mhm.
But while displaying the reports, will it be converted to positive to negative, negative to
It
positive?
will
That
be
is
converted.
something.
Obviously, we convert negatives to positive in the reporting layer.
Mhm. Yeah.
Okay. So don't worry, how we convert, I'll discuss. We define what is an income account, expense account. Based on that, we'll do conversions. Based on account type, we do conversions. Okay. These websites, for better understanding, they will put generally in reporting, right, we show whether it is receivable or payable in positives only. Both will be shown in positives in reporting. Okay. But if we add up, if we add income account and expense account, one will become negative, one will become positive. Okay, it will actually subtract both, though both are positive numbers. If you add income account and expense account, one will be subtracted from other. Okay, if your top account is income account, then income account, for suppose we have operating profit, guys. I show you operating. So you have net sales of 10,000. So you got sales. This is 10,000. You got expenses, or you have cost, which is 8,000. Okay, then you have profit. So guys, if you profit is getting calculated from these two. Here sale is an income account. Sale is income. Okay. Cost is expense account. Profit is also an income account. Then what happens? So this value will be contributed in positive way. This value will automatically become negative for profit. So 10,000 plus minus 8,000 will give you 2,000. It will be 2,000. Because income account will obviously contribute. So here the top account is income. This profit is getting calculated from these two, right? So this account will contribute in positive way and this account will contribute in negative way. So this is how we show in reporting. Reporting, everything is shown as positive number, but difference. And again, guys, for suppose under this cost, okay, under this cost, we have raw material cost, that is 8,000, so to 6,000, and labor cost, which is 2,000. So guys, these two will contribute positive to the final cost 8,000, because this is expense account, this is expense account, and final is also expense account. So these all will contribute positive, and your overall cost will become 8,000. 6,000 plus 2,000 will become 8,000. Understood? If your top account, okay, whatever you're aggregating to, if that is income account, so all underlying income accounts will contribute in positive and expense accounts will contribute in negative. If your top account is expense account, all expense accounts will contribute in positive manner and income accounts will contribute in negative
At
manner.
the
Okay.
end, if you get negative value, Satya,
At the end, if we get negative value, it means we are going for a negative profit. It's a loss.
so it is shown up in negative.
It shows up directly negative. For suppose your sale is only 7,000.
Yeah.
Cost is 8,000, it will be minus 1,000, means your profit is minus 1,000, which is a loss of 1,000.
Yeah.
Okay. Accounting is different from accounting reporting, financial reporting. In financial accounting, you see negative numbers like your receivables are in shown in minus, your means your credits are in minus, your debits are in plus always in accounting, normal finance accounting. But in reporting, you don't see minus for the report receivables and positive for debits. We see only positive numbers, and we aggregate based on the income and expense accounts. Understood? Clear? Any questions here, anyone? I'll show it up, guys, not to worry. Yeah, so that is about your statements. Just give me a minute, please. Just guys, I'll be back in a minute. I'll cover the subdomains we have, direct and indirect GL accounts and everything. Okay, so guys, now let's go on to some subdomains we have under finance. Okay, so in finance, we have like 4 subdomains. I think most of you know it's that is accounting, internal transactions. Then we have accounts, payables, like anything we deal with vendors, right? Anything we are paying out to the vendors, so that falls into uh, accounts payable. Anything we are receiving from customers, and this falls into accounts receivables. And then all your assets and liabilities will fall into asset accounting, AA. Okay, and all your internal transactions, like whatever you're paying on operating expenses, production costs, employee expenses, they all falls into this normal accounting. Okay, so like 4 subdomains we have in finance. I'm not really worried about that right now. In planning, we don't we don't really work on accounts payables or account receivables. Okay, guys, in GL accounting hierarchy, so guys, GL accounts always are maintained in a hierarchical way, guys. So you should see, guys, to understand financial planning or to understand finance, you should understand your GL accounting hierarchy. So any company, almost in all the organization, the GL accounting hierarchy is more or less the same. Okay, maximum companies uses the SAP's GL account hierarchy. They don't create their own accounting hierarchies. They all use the standard hierarchy given by SAP. Okay, you know, SAP in FICO module, okay, in finance and controlling, SAP gives you a standard GL accounting hierarchy which will be used by all the companies. Okay, so you should, if you have some time, please try go and look at the GL accounting hierarchy. Okay, so I'll tell you, maybe if I open my slides here. So guys, you see your P&L statement. So your profit and loss statement contains your top line as net sales. Okay, so here you see. Then we have cost of goods sold, which is nothing but your production cost. Okay, then we have gross profit. The sales minus production cost gives you gross profit. Then we have operating expenses like your sales, marketing, IT, employee expenses. So this minus this gives you an operating profit. Operating profit, or we also call EBITDA. So we define our planning till operating profit. Then we have other incomes or other expenses. Then interest expense. Extraordinary gain or loss you don't see for companies majorly. You don't see extraordinary gain, extraordinary loss. Means if there is some fire accident happen, then it will fall into extraordinary loss. Means there is some fire accident happen in your one of your plants and it got some damage, so it will consider as an exceptional item. Exceptional items is what we call it. Extraordinary gains or extraordinary loss means exceptional items. Or your company has got a tax notice of this much amount, okay, that's an exceptional item. Okay, there will be some exceptional items. Or your company paid some extra tax and the government has refunded something, it's called as an exceptional items. Okay, or your company has, I'll give a simple example, guys. ICICI Bank, okay, in one of the quarters, their normal numbers are very normal, but their net income was increased by 100% because this ICICI Bank has got some stake in ICICI life insurance, something Prudential life insurance, and they sold that stake. Due to that sale, there is a big exceptional item which increased their net profit. And in one of the chemical company, their operating profit was very good, but net profit was in negative because they had a fire accident in one of the plant which had an exceptional item. So exceptional items are not seen very regularly, not seen in every quarter or every year. They are seen once in a while, so you can ignore them. So operating profit, then we have other expenses or other incomes, then interests we pay on the debts, then the net profit before tax, and then we pay the tax, and we see the final net income. Okay, so we always plan from net sales to operating profit. We always plan the operating profit for the next financial years. Okay, we cannot plan for the we cannot plan the other incomes, we cannot plan the extraordinary losses, right? Extraordinary loss we cannot plan, right, for a fire accident or some exceptional item. We cannot plan interests because that is based on the debt, and you cannot plan your taxes. The only thing we can plan is your sales, your product, your expenses. Sales and expenses can be planned. So we always plan to operating or profit. Okay, so this is where we do our planning. Okay, so generally guys, we get two types of accounts. One is direct account, where financial transaction or posting directly happens on an account. Okay, second one is an indirect account, where the value is calculated from the underlying accounts. Okay, I'll show this up. What is direct account, what is an indirect account? Please just give me a moment, please, just a moment. Okay, so guys, here you see, let me open my accounting hierarchy. See, generally guys, we don't build accounting hierarchy. We never build accounting hierarchy and the reporting layer. We always consume the accounting hierarchy, whatever maintained in your source in the sense. The GL accounting hierarchy should be always maintained by a finance team, not the planning team, not the reporting team. Okay, so that accounting hierarchy is always maintained by a core finance team. Okay, I repeat the statement. We, as a planning team or a reporting team, we never maintains an accounting hierarchy. We will just consume that accounting hierarchy from your source. It might be ECC or it might be S4HANA. Okay, and most of the organizations, they don't build any generic hierarchies. They will use the hierarchy given by SAP only. SAP now, you know, guys, SAP comes with a pre content object. Okay, see, if you see my accounting hierarchy, guys, so this is your P&L statement. So top line is operating income. You see this. Let's focus on actual 2023. Operating income is nothing but your operating profit here. This is nothing but operating profit. This operating income is generated from gross profit and operating expenses. This operating income is generated from gross profit. It is generated from gross profit and operating expenses. Gross profit minus operating expense gives you operating income. Here you see 2246 minus 1727 gives you 858. Here you see, guys, if you observe carefully in reporting layer, you see both positive numbers only. But gross profit is an income account, operating expense is an expense account. So this value minus this value gives you the operating income, which is again an income account. So for operating income, gross profit value will be contributed in positive way because both are income accounts. Operating expense value will be contributed in negative way because it is an expense account. Here in reporting layer, you see both income and expense in positives. But when you're adding up, if you see, this is nothing but your 2246 minus 1727, guys. So here you see this. I cannot edit because I logged the 2246.08 minus 1727.5. So you can see 518.83. That is what you see in operating profit. This is nothing but gross profit minus operating expense. Okay. So again, guys, now if you see here, if I open the operating expenses, if I open my operating expense, this operating expense is calculated from sales and marketing expense. Okay. Personal cost is nothing but HR expenses, means employee expenses. If I open personal cost, you see employee expenses like salaries, wages, bonus, burden, training cost, recruitment cost, tuition cost, etc. This is nothing but HR expenses. Then you have sales and marketing, where you have sales expense and marketing expense. Then you got IT expenses, other expenses. These all day-to-day means expenses need to run the day-to-day operations of a company are operating expenses. Okay. So if you see here, guys, here sales and marketing is an expense account, personal cost is expense account, IT is an expense account, and other expense is also an expense account. So as these all are expense accounts and my operating expense is also an expense account, so they all will contribute in positive way. If you sum up all these four, you'll get 1727 million. This is 900 plus 150, 1050 plus 160, 1110, 1210, 1210 plus 516, right? 1726, 1727 is what you see here. Okay, that is how you see the values. Right, so these all give are expense accounts, and your final account is also an expense account, so they all will contribute in positive. So that is how income expense accounts are summarized in reporting, added up in reporting. So generally we have operating expenses, so where we plan for marketing expense, we plan for HR expenses, IT expenses, etc. Okay, here, so your operating income is nothing but gross profit minus operating expenses. If I open gross profit, guys, gross profit is nothing but revenue, your sales minus cost of goods sold. Cost of goods sold is nothing but production cost. Here you see gross profit is calculated from net sales, means net revenue minus cost of goods sold. So what is your cost of goods sold? It's nothing but your production cost, guys, like raw material cost, labor cost, purchase price variance, vendor chargeback, freight cost, etc., etc. So this is nothing but your production cost. And if I open net revenue is nothing but gross revenue minus discounts. Gross revenue generated minus discounts gives you net revenue. And in discounts also you have different types of discounts, like pricing adjustments, means 10%, 20% adjustments, sales allowances, sales discounts, sales markdowns, etc. Okay. Then gross revenue is calculated from gross sales, means your original sales, minus retail returns. Retail returns in the sense someone returned the product back, it's a retail return. Okay. So you see, from sales minus returns gives you gross revenue. Gross revenue minus discount gives you net revenue. Okay. Gross revenue minus discounts gives you net revenues. Okay. Net revenue minus cost of goods sold gives you gross profit. Production cost gives you gross profit. Gross profit minus operating expenses gives you operating income. Operating income or operating profit or EBITDA. Okay. So we actually plan on these accounts, guys. We plan on sales. We plan on discounts, means we gonna forecast how much sales we gonna achieve in the next financial year. Okay. Then to achieve on that sales, how much discounts we gonna spend, how much we gonna spend on pricing adjustments, sales allowances, etc. We do planning on discount or for. Okay. Then we gonna do a production planning here. Okay. To achieve the sales of X, how much we should spend on production, out of which how much should go to raw materials, etc., etc. Okay. So then we'll do OPEX planning. Okay, how much we're gonna spend on marketing for next 1 year, how much we're gonna spend on IT, how much we're gonna spend on employee costs, etc., etc. Okay. And then once the forecast plan is ready, we'll do budgeting. Okay. See guys, in marketing, we are saying that we're gonna spend 100 million. Out of 100 million, how much we're gonna spend on different offline marketing, how much we're gonna spend on online. Okay. Again, your company is operating in 5 regions. In region 1, offline marketing, for suppose overall is 100 million, out of which offline marketing 40 million, online is 60 million you given. Then what we do the budgeting. Okay, out of this 40 million, region 1 will get 5 million, region 2 will get 10 million, region 3 will get 6 million, like that. We'll do budgeting. We'll allocate that numbers to different regions. Okay. Same for IT also, some for HR expenses also. Based on number of employees, we'll allocate to different regions and different departments. Budgets will be allocated, means we'll generate the top line numbers and we will cut down that numbers to, or we'll allocate that numbers to underlying departments, underlying regions, underlying products, etc. So we're doing the production cost, guys. We set the overall production cost number, but out of that production cost, you got 5 products. How much we gonna allocate to product 1? How much we gonna allocate the production cost to product 2? Like that. And you got 10 plants. 5 products are produced in each and every 10 plants. In first plant, first product, how much we gonna allocate? First plant, second product, how much we gonna allocate? So means we gonna break down your overall numbers into subcategories. That is what we call it as budgeting. First, we generate the future numbers, forecast the numbers, generate the top line numbers, and then we cut down that numbers into different regions, different products, different plants, okay, different stores, etc., etc. It depends on the organization, how the organization operates. Okay. In my case, I'll actually distribute to regions and products. So that is what we call it as budgeting. Understood, guys? So what exactly we plan in financial planning? Any questions here, anyone?
The immediate node is means the negative value means the subtracted value of the lower levels, right? Lower nodes, Satya?
Yes.
For respective hierarchy node. Okay.
Yeah. So generally, guys, in GL accounting hierarchy, we got 2 types of accounts. One is direct account, another is indirect account. See guys, here gross sales is a direct account where a posting happened directly, a financial posting or a sales posting happened directly on this account. Okay. So if we are receiving some cash or something from the customer, it will fall into gross sales account. So as this gross sales account is directly present in a financial transaction, it is a direct account. It's a direct accounting. If you have an account present on any financial transaction, it's a direct account. But if an account value is calculated from an underlying accounts, it's an indirect GL account. Here gross revenue is an indirect account where no financial transaction directly happens on this account. It is calculated from gross sales and retail returns. Understood? Here gross sales and retail returns are direct accounts where a financial transaction or a posting will directly happen on these accounts. Direct happens. Okay. Whereas gross revenue is an indirect account whose value is calculated from the underlying accounts. Even net revenue is an indirect account whose value is calculated from gross revenue and discounts, right? Even gross profit is an indirect account, value calculated from net revenue and production cost. Operating income is also an indirect account calculated from operating expenses and others. Understood, guys?
Then only
So
the
if
direct accounts,
the
the
leaf
direct
notes,
accounts.
the leaf notes means the very lowest notes are direct accounts, and all notes on top of the leaf node are indirect accounts. Very simple. The leaf nodes or the lowest nodes are direct accounts where the transaction will happen directly on that account. Means when when you create a financial document or a financial transaction, we make use of these accounts, direct accounts. Right. So here pricing adjustment is a direct account. If any discount is given, guys, so an account a transaction will happen directly on pricing adjustment, sales advances, etc. So they all will calculate sum up to discounts, which is an indirect account. Okay. Same for production costs, for operating expenses also. Okay. Here personal cost is also an indirect account which is getting calculated from underlying accounts like sales, salaries, wages, etc., etc. If we pay the salary, so this much amount will be debited from this account. Okay, so this is a direct GL account. Salary is a direct GL account, but whereas personal cost is an indirect GL account getting calculated from this. Right. So like that we see two types of accounts. If your financial posting can happen on an account or a transaction can happen on an account, it's a direct GL account. So you will see the numbers adding up or decreasing in that account because the credit and debit postings happen on that account. And indirect GL accounts, guys, those values will be calculated from the underlying accounts. Very simple. Okay, and it's a very simple parent-child hierarchy. It's a very basic parent-child hierarchy. GL accounting hierarchy is a parent-child hierarchy. Okay, where parent node values are always calculated from the children node. Clear? And this accounting hierarchy is maintained in your transaction system. We don't maintain it manually as the planning team or reporting team. We always consume it from the source system. First thing, this should be maintained by your finance and controlling team. Even in maximum companies, not maximum, guys, almost all the companies, even your finance team also don't create this hierarchy. They will use the hierarchy given by SAP. You know, SAP comes with pre-built content. In that you have GL accounting hierarchy is also inbuilt, and they will use it straight away. Because in any company, the P&L statement looks same. Okay. Clear, guys? Any questions here? Right. So guys, we will be starting with finance, profit and loss planning. Okay. So I'll start with income statement planning in the next session. So what I do is I'll first show you the data first. What is my data, transaction data, master data, everything I show, and I'll try to build a transaction data model in the next session. So before I go into that, so let me show you how a planning process work. Okay. So I'll be starting working on the system from next session, guys. So that's it. First 3 sessions are intro sessions for me. Okay. From day 4, it is all on the system. So generally, first step, what we do is, first step in your planning process is preparation, data preparation, guys. So here, the data preparation is always done by the SAC consultant. I tell you, in planning area, just a moment, please. Okay, that is unlike in business intelligence. In business intelligence, what we do, we just end users will come, give the requirement, that's it. So we develop end-to-end reports, everything we develop. Okay, but when it comes to the planning, so both teams work in parallel, guys. I told you. So both an SAC team and the planning team, they both work in parallel. Okay, and develop the plan, financial plan, because I already mentioned the planning involves data distribution. Data distribution means the changing the numbers, managing the numbers, because planning is future data, and the planner who has a complete understanding of the business can only set the numbers. Okay, so that's the reason both the teams work in parallel. So I'll give you which teams handle what activities here. So generally, guys, the first step in planning process is getting the data from your system. Okay, what we do, we actually connect with your source system. If it is finance data, guys, we connect with S4 HANA. Okay, because the finance system is S4 HANA system for us. We connect with majorly with S4 HANA system. Get the data, get your actual data from S4. Okay, get the actual data from S4. And first step is data preparation, means building the planning model. So preparation in the sense, we connect with a source system, get the data from the source system. We do master data management also here. I'll clearly show you how we do master data management. First step, we do create a planning model. Okay, we maintain master data, actual data, and create a planning model, create currency conversions, everything, and build a beautiful planning model. That's the first step. Okay, and this data preparation is completely done by the SAC consultant. Guys, the next 2 sessions I'll completely work on data preparation part, planning model. And once your planning model is done, so guys, scheduling comes at the last. It's unfortunately we written schedule here. Schedule should come here. Between finalize and prepare, the schedule should come. Once your planning model is ready, the second step is predictive forecasting. So means, guys, for suppose, imagine we are at the beginning of financial year 2024. The planning always starts at the beginning of the financial year. Okay, so what I do in my systems is I'll get you the historical data like 2021, 2022, and 2023 historical data into the planning system, that is SAP Analytics Cloud, and build a planning model. Okay, then earlier, guys, the forecasting used to be a manual process done by the planning team, but now we will forecast the numbers using AI and ML, using predictive forecast. So using this plan data, using this historical data, we're gonna forecast our future sales numbers for financial year 2024. I'm going to do P&L planning for financial year 2024 for your batch. I'm gonna do P&L planning for next financial year 2024. Okay, means imagine right now you're in January 2024, not in May 2024. Imagine you are in January 2024. You have data till December 2023. We're gonna use that historical data, use our machine learning algorithms, time series forecast to generate the forecast, the sales forecast for next financial year 2024. So this predictive forecast is also generated by the SAC consultant only. We only generate the predictive forecast. Once our predictive forecast is generated, the real planning starts. Okay, once we generate the predictive forecast, the real planning starts. Then the planners will come, apply their human intelligence on the predictive forecast and generate the final forecast. Okay, they will use the inputs and adjustments. Okay, use means, guys, generally we use AI and ML and forecast our future numbers, but the planner who knows the ground reality will come, make some adjustment on that forecast number, plus or minus 5% here and there. Okay, and gives you the final forecast. Means, guys, we have 2 layers in the forecasting. First is system forecast. We have 2 layers in forecasting. First, we use machine learning algorithms to generate a system forecast. Then the planner will come, apply his human intelligence on top of system forecast and generate a final forecast or baseline forecast. First step is forecasting. System forecasting is done by SAC consultant, but the final forecast, so the planners will do some data adjustments and generate the final forecast. Once the final forecasts are ready, once your final forecasts are ready, guys, this is a big step. This is big step. Planning is big step. 70% of the time we'll sit on this step only. Remaining all steps will take 30% time. Planning itself will take 70% of our time. Okay. Then the SAC consultant will come. Once your overall plan, high level plan is ready, so then it has to be distributed or budget. Then the budgeting starts. Guys, once your forecasting is completed, the budgeting starts. There are a lot of things we need to do in forecasting. I'll cover it up. Okay, I'll clearly cover a lot of things to do in forecasting. I just written in one statement, but I'll take at least 4 to 5 sessions on forecasting. Okay, then the real budgeting starts. So then we'll distribute that overall numbers, your overall production cost to different regions and different products. Okay, your marketing expense to different types of marketing. Okay, we'll integrate the HR planning data to get the HR expenses. We'll do integration planning also. Okay, guys, then what we do, we integrate the planning in the forecasting. Okay, to generate the for HR planning, we will generate a separate headcount plan and integrate that to finance plan. To generate a marketing plan, we generate a separate marketing plan and integrate to finance plan. We generate a separate IT plan and integrate to finance. For production cost also, we will get data from IVP, but in my case, I cannot load from IVP. I'll generate the production planning also within SAC. Once sales forecast is ready, the final forecast is ready, we will actually do separate planning on HR and integrate it to finance. Separate planning on marketing and integrate into finance. You see the collaborative planning. Then the collaborative planning happens, guys. Once forecasting is completed, then the collaborative planning happens. Once your collaborative plan is also completed, okay. So once the collaborative plan is completed, then we'll go on to budgeting. Then we'll actually start with budgeting the numbers. Means we'll start distributing. We will actually start distributing your numbers to underlying regions and products. So that is what you see in distribution and allocations. In distribution and allocations, you see the real budgeting happens. Okay. So once your budgets are completed, your plan is ready, your forecast is done, then integration is done, then budget is done. Okay. Then that budgets will be exported back to S4HANA system. The budget numbers will be exported back to S4HANA system to do all the consolidations. Okay. So then once your plan is completed, the third step is planning, the big step. Almost I'm gonna spend around 10 to 12 sessions on that planning step itself. The third step itself will take me 10 to 10, 11 sessions. Okay. Then once the planning is done, okay, then we go to visualizations. So then means we set the plan for financial year 2024, guys. Then every new month we'll start getting the actual data. Right, once month of January 2024 is completed, we'll get January data, February data, March data. We'll start getting the actual data. Then what we do is we'll build up some dashboards which use your actual versus forecast, actual versus budget, whether actuals are going above the forecast or going below the forecast numbers, whether we are overutilizing the budgets or underutilizing the budgets, in which areas we are overutilizing, in which areas we are underutilizing the budgets. We're going to build a beautiful dashboard to showcase what's happening in the business. Actual versus forecast, actual versus budget. Based on that, the planning team will go on revising the forecasts. We keep on revising the forecast based on the actual numbers flowing in. Means we set the plan for one financial year always. We always do the financial year planning at the beginning of the financial year only. Okay. We always plan for one financial year at the beginning of the financial year, but we keep on revising the numbers with the actuals flowing in. With the actuals flowing in, we keep on revising the numbers. Okay, that we're going to build beautiful dashboards to show actual versus forecast, actual versus budget utilizations, and keep on and the planners will keep on revising the numbers based on that. Okay, we're going to build the visualizations, but plan revisions will be done by the planning team. Okay, and once your plans are completed, we submit the data, we log the data so that no user can change the historical values. Okay, and we forward the data to the business users. So right, I told you, right, we give the reports to the business users so that they can start utilizing that planning reports and start running their operations. And once that is done, we'll automate our planning process using scheduling. Okay, some budget reallocations, I want to run it every month. Okay, we have month-end close operations, guys. Once your month-end closure is completed, there are some operations we need to do in the planning system. So those operations can be automated. You don't need to go and run it manually. We can automate them. Okay. We will automate them using planning calendar and some tasks. Okay, that will be the final step of your planning process. First step is data preparation, creating the planning model. Second step is predictive forecasting. Okay, I need exactly 2 to 3 sessions to complete first two steps. Then we have 10 sessions on real planning. Okay, so where we generate the final forecast, then we do integration planning, integrating HR and marketing plans to financial plan. Then we do budget reallocations. Okay, then once your budgets and forecast is ready, we will build some dashboards to compare actual versus forecast and actual versus budget and review the things. Okay, that will take hardly 1-2 days. Reviewing is 1-2 sessions, that's it. Then we'll go on finalizing, submitting the data logs, forwarding the data. It's a one session process. Then we have 2 sessions on automation, automating all your planning process. Okay, so this is what we're gonna do as part of our planning. We're gonna generate an end-to-end plan here, guys. Okay, I'll show in both ways. I'll generate an end-to-end plan. I'll show you how an SAC consultant work and how a planner work. I'll show both ways. I'll do an end-to-end implementation on the planning. All right, makes sense. Any questions here, anyone?
Satya, you talked about historical data. You were saying, correct me if I'm wrong. So, you were saying like we should assume on Jan 2024 and prior year should be historical data. So that should be our actuals, right? Here,
That is our actuals,
uh,
yes.
actuals. And when we plan, right? So all these 12 months, like I'm talking about Jan 2024 to December 2024. So let's say we have forecasted for the 12 months. When we jump into Feb 2024, so ideally this Jan 2024, uh, I mean that data should I mean if it is gets completed, it should get changed to actuals, and from Feb to December, it should be in forecast. So how this change happens?
See, that's we call it as forecast layout. I'll show you how we change it.
Okay.
See, generally we don't change the forecast to actual number. Okay, forecast numbers are stored in forecast version. Actual numbers are stored in actual version. Okay, you have maybe there is a scenario for that.
But see, what I was trying to ask you is when
I
we
understood
run
that.
some report, yeah,
That is
the backdated month, I mean,
the backdate
shouldn't be
month.
showing as forecast. It should show, it should get changed from forecast to actual, right?
It will not, but we can show in the reporting. I'll show you. See, these are like review reports. In the review reports, so once I generate the plan, I loaded the actual data also for first quarter. For January, February, March 2024, I loaded the actuals. So this gives you forecasting accuracy. Okay, how much accurate your forecasts are. Okay, this is accurate. Here you see there is an option called forecast layout. In the forecast layout, you see on the backdated months, I'm showing the actual data, and forward months, I'm showing the forecast data, and this is your overall number.
Mm-hmm.
Your question is answered, right? We don't replace.
Yeah, yeah.
We have an option to show the back data on actuals and forward data on forecasts. Once I have actual data for April 2024 also, even this number will be shown in actuals. From May, it will show in forecasts.
Okay, okay, got it.
This is a scenario. I'm going to cover it up. These are review reports. In the review reports, we do that. I'll show it.
Okay.
Okay, so means once we generate the plan, I'll show how reviews happen. I'll load some actual data for 2024 also, and I'll compare your actual versus forecast, actual versus budget. How much percentage of budgets were utilized? Here you see budget utilizations, you see here. over underutilizations, whether your budget is exactly utilized or it is overutilized, underutilized for that quarter. Okay, so these all things will be covered, guys. This is for previous batch. These all are some things created for your previous batch. It will be covered for your batch also. Okay, so you see a beautiful flow of planning. Okay, I very honestly say, guys, if you attend properly the planning sessions, you will like them very honestly. So you like them much better than BI sessions. Okay, I don't know whether you like my BI sessions or not. You will like my planning sessions for sure. Okay.
How many planning models we are going to build as part of sessions? How many planning models we are going to build?
I'm gonna build 2 planning models. One is finance, one is HR.
Only 2.
Yeah, only 2. In real world also, you don't see multiple planning models. In planning, you hardly see 2 to 3 models in your system also.
Okay.
Planning, I'm gonna do a lot, but model building is only one.
Okay, got you.
In real world also, in finance, you see only one plan model.
Yeah.
Everything is built on that model.
Yeah, got it.
As you see here, on one planning model, I'm going to cover how many planning scenarios. I cover around 20-25 planning scenarios, guys. Here you see, once the planning model is built, I'll start with planning scenarios, predictive forecast, first planning scenario, data distributions. It's like that. If you scroll down, see around 25 planning scenarios, guys. I'll touch base each and every aspect of planning. Okay. All right, guys. So I stop here. So we'll start with planning modeling in the next session. I'll start with data preparation first. Okay. I'll create the planning model in different way, guys. So far, I didn't focus really on modeling, data modeling as of now. I created basic models, taking data from files. I was more and more focused on reporting because in business intelligence, we do only reporting because we use live connections. We don't do data modeling. But in planning, we do real data modeling. So I'm going to show you how master data management is done first. Okay, we maintain master data first through public dimensions and use them into transaction data models. So in the next session, I'll first start with master data management. First, I'll give you an overview on my finance data. Okay, and then I'll start working on your master data management. Maybe 2 sessions. I'll create a planning model. I'll apply some currency conversion on the planning model. Next 2 sessions is on planning model. Okay. So I stop here. So let's meet on Monday. Thank you so much.
Thank you.